Robi.
And today we're starting this chat in a different style. They say that 7 is the number of completion, but today is the number of completely looking behind and appreciating how far we've come. One cold morning of April 14th, exactly the same date as today, but the year 2016, Giching'a made his debut on KTN News. Take a look at this.
Let me first of all start by introducing our panel this morning. And I'll start with my immediate left, where we have Dr. Fred Ogola, who is a lecturer at Strathmore Business School and also a strategy consultant. Great to have you, Dr. and welcome.
Thank you.
We also have Ken Giching'a, who is a chief economist. Welcome.
Thank you.
And last but not least, we have Giching'a, who is from our business desk and, of course, is going to be helping us as we steer this conversation. So welcome, gentlemen, and thank you for having you. And
interest rates are going extremely high. And this was a reaction to our currency account, our foreign exchange account, which was bleeding. You remember the dollar last year was at 89 to the shilling at the beginning of last year. And towards the end of the year, it approached about 100. So the central bank responded by increasing interest rates so that to at least to stem that tide.
Wow, Ken Giching'a, 7 years. Imagine, first of all, I don't have to comment about the sofas. You guys looked very comfortable that morning, you know? This is a very homely show. But, I mean, you're talking about the dollar last year, the previous year, 2015, being 89 shillings. Now we are talking about 130. Time has changed. What comes to mind when you see that?
Oh, it seems like an eternity then. And I remember the thesis of that whole episode was to analyze the Chase Bank collapse at that time and the banking turmoil. And obviously that was my first episode. So to see those numbers, as you said, dollar shilling at 89, it almost feels like it was a different world.
I know.
So I think it's I'm just grateful that we've seen so much on this show.
Yeah, that's incredible. Do we have Odhiambo Ramogi able to see us virtually? Okay, yeah. Thank you very much. Ramogi is here with us. Good afternoon, sir. Good to see you. Have you seen Giching'a's 7 years ago, the way he looked very calm and composed on those sofas?
Well, yes, I celebrate him. 7 years on TV is not a short time. Congratulations. And I hope that the government has been taking your advice. Although the dollar is not seeming to respond to Giching'a's advice, but at the same time, I think it's a very good moment to celebrate.
Wow, that's beautiful to note, and we really appreciate you. I think the lesson here is consistency. 7 years. Yeah, that's incredible. I don't know when Ramogi joined, but when you turn 7, Ramogi, hit me up so that I also have something similar for you. But right now, I'd like us to go straight to our top stories that we are analyzing. And talking about economic outlook, this one specifically is markets outlook. Monetary Economics released its global market outlook, revealing that productivity gains will be the surest way of taming inflation. The report also cited the World Bank's report, which is projecting a global growth of only 2.2% a year for the rest of the decade, down from 2.6% in 2011 and 2021 and 3.5% in the first decade of the century. It prescribes a boost in productivity and labor supply, ramping up of investment and trade as the solution. And I'm glad we also have Ken Giching'a here, doubling as lead economist at Mentoria. What really stood out in preparation of that report?
Thank you, Noah. When we are putting together the report, we are putting it in the context that we're in a very complicated world. A world where interest rates are high, inflation is surging, COVID-19, we've had 3 years and we're still feeling the effects. And also the Russia-Ukraine crisis is still unrelenting. And there's a thinking that if we are not careful globally, we might have a lost decade of growth. and there's a feeling that we need to have productivity gains. We need to make serious productivity gains because the recent IMF report talked about a dip in global growth from 3.4% down to 2.8. And here in Kenya, we are lucky we are doing 5% growth. So I think the thinking around it was to say, yes, central bank is raising interest rates, but can that really cure cost push inflation? Because that's what we have right now. It's cost push inflation. Central bank tools are best cured for demand pull inflation. Okay. So what we really need is to improve productivity, because if you can produce, a factory can produce more shoes, then the average cost per shoe becomes cheaper.
Okay.
And that sort of reduces the price. So I think we need to think about productivity as we move forward.
Definitely. Ramogi, going through the report, and I know Ken sent us the report quite early and encouraged us to subscribe to Mentoria, to be able to be getting this report. But what is the greatest takeaway? Do you think productivity is the antidote to all these economic upheavals that we've been seeing?
No, I agree with Ken in a big way. We tend to overestimate what we can do in a year and underestimate what we can do in 10 years. And having a report with such a wide view, with a local understanding of the situation as it is, gives you perspective. It makes you understand what can be lost or what can be gained in such a time. And in 10 years, Singapore was able to turn around. In 10 years, Germany turned around the challenges it had with the Second World War. In 10 years, China made significant strides between the 90s and the 2000s. And so 10 years is a long time. And he's warning that it is possible that we can lose a whole decade of growth is very sound. Now, of course, there are many other factors that would contribute to that growth, including good governance, including proper management of economics, and that also needs to be put into consideration. But still, the pointed focus on productivity makes a whole lot of sense.
Definitely. And talking about reports, tentative signs in early 2023 that the world economy actually could achieve a soft landing. This is actually not the case according to IMF's report. And just going through this particular data that's coming out with the spring meeting ongoing, actually they say that this soft landing with inflation coming down and growth steadily having receded amid stubbornly high inflation and recent financial sector turmoils, this is not the case. Looking at this report also, we've seen, according to the IMF's World Economic Outlook, a global headline inflation is set to fall from 8.7% in 2022 to 7% in 2023 on the back of lower commodity prices, but underlying core inflation is likely to decline more slowly. Inflation's return to target is unlikely before 2025 in most cases. Once inflation rates are back to targets, deeper structural drivers will likely reduce interest rates towards their pre-pandemic levels. And Ken, we see this tunnel vision of going to the pre-pandemic levels. And IMF is saying the likelihood of us hitting those levels before 2025 is very unlikely. How do countries, especially developing economies, navigate this?
Well, it's a tough position because much of it depends on what's happening in the United States. The inflation numbers that came out this week shows that inflation in the US is about 5%. It is coming down, but it's higher beyond the 2% target, which means the Fed might continue with the interest rate tightening, raising interest rates. What that does is it makes more dollars leave countries like Kenya, like Egypt, like South Africa to go to the US to look for those higher returns. So as long as the interest rate outlook in the US still is for tightening, then developing countries find themselves in a very difficult position where they face what is called a flight to safety, dollars leaving these markets. And that's why you find like our government now has to come up with other arrangements like fuel to be able to safeguard our economy, because if you depend on the dollars, and these dollars are all going back to the US, then developing countries find themselves between a rock and a hard place.
Definitely. Ramogi, we've seen President William Ruto speaking about this particular issue, and even the Deputy President reiterating that if you're hoarding dollars, just go. You have today and yesterday, because the dollar is coming down. There is a certain kind of confidence that is one of the shilling strengthening against the dollar. And secondly, also we are seeing alternative talks in terms of dollar-backed global trade. Talk about the BRIC countries trying to find alternatives around this. In terms of the dollar being at the center of global economy, is this the sign to an end?
Well, first of all, yes. What Ken has said about the US inflation rates and the impact it has on dollar availability across the globe is a reality. But I have always thought that the IMF can be an alarmist. And if you follow everything they say, I think you'll be a very stressed person. I don't agree with them that we may not have a soft landing. And I think they are making this assumption based on over-reliance on the dollar on one part, and based on the fact that there's a war going on and they probably do not foresee its end. So on that, I differ with them significantly. And I differ with them partly because of what you have alluded to, which is there is more and more growing concern about over-reliance on the dollar as the standard of currency of trade globally. This started especially around the time Trump was president, and made everyone uncomfortable. I think India, Pakistan, Turkey, Russia, he just disrupted trade, as was the case before. And so we started seeing bilateral arrangements between one country and another to do business within using their own currencies. And so that now made the rest of the world to actually appreciate the fact that, wait a minute, you have sovereignty, which means if the two of you as two countries can agree, you can use your own currency. Now, so that now has made the BRICS country to embolden, and they have decided they are coming up with their own currency. Now, that's difficult because they'll need a central bank and the institutional framework around that. It is easier to accept and say, let's use the South African rand or the Indian rupee or the Chinese yuan. It's easier to use one currency as opposed to create a new one altogether, because you'll have to do an institutional framework around it. But at the same time, Ghana has also said that they are going to trade using their own currency and backing it up with gold. And so you see more and more the world is thinking more creatively around a common currency to use as opposed to over-reliance on the dollar. Right. Locally, the president has come clear that we are going to do business with Pakistan using the Kenya shilling, do business with Iran using the Kenya shilling, Saudi Arabia using the Kenya shilling. This then makes it easier for the pressure on the dollar to reduce, on one hand, and number two, it makes it easier for the prices of goods to go down, because oil is a bigger factor in the inflation. And so there I don't agree with the IMF. I think, yes, the president is trying to encourage us not to hoard dollars, but at the same time, there is a reality behind his statement that the deals they've struck can actually help us manage inflation and the exchange rate.
All right, Ken, these alternatives that we're seeing amidst global, as they say, it is a perfect alignment, sort of a perfect storm, one hit after the other, and it's forcing everyone to rethink about where they stand economically. These alternatives around the greenback, what's your thought on it?
Well, I think there is a point that Ramogi has made, that changing geopolitics also introduces what you call geoeconomics. Basically, people start aligning with countries of a similar nature. So we have the BRICS, the Brazil, Russia, India, China. But I don't think it's a new story. If you look at the percentage of global trade in US dollars 20 years ago, it was about 80%. That has reduced right now to about 59%. So it's not a new story. It's something that has been happening over time.
Yes.
America are aware of it, and I think they're already preparing for a world where there'll be a basket of currencies. So I don't think it's going to be a breaking news story to people who've been looking at it from a long-term perspective. But at the end of the day, currencies, fiat currencies, get their authority from the law. They don't get the authority from commodities. The world moved away from gold standards, commodity money. What we have today is fiat money, and fiat money gets its authority from the Constitution. And in my opinion, in my humble opinion, the Constitution in this world that is considered to be possibly the greatest in terms of freedom and democracy and transparency is still the American Constitution.
Okay.
And as long as that is the case, it's always going to be considered, when you talk about flight to safety, the place to go. So yes, the BRICS might come with their own bank, but when you think about Russia and China, their constitutions, these are countries that are politically very single party state. So I think the US will still continue to have the upper hand, not because of people need dollars to buy oil, but just because it's anchored on a constitution that guarantees the greatest human rights, freedom, and democracy.
Okay. Gentlemen, and I know Ramogi wants to respond to what you've said.
Right.
Respond to your humble opinion. But we want to take a short break. When you come back, we'll be looking at Kenya as a household. Have we spent our money of late? Looking at our budget for the past month. Were we diligent enough? Were we spending more than we were making? How do we balance our household budget? The house being Kenya. That coming after this short break.